Hey, Sam from Your Property Network, and today I'm joined by someone I've been desperate to interview for months and months, and I've been haranguing him and stalking him, and he's finally relented, and I've worn him down and got him on. We're kind of getting him into the pages of YPN, and this is someone I follow online a lot, and we're going to talk about, why in a minute. But first of all, Adam Lawrence, thank you for joining me today. So I know you from YouTube videos, kind of Facebook posts. You do some stuff with, I know you're heavily involved with partners in property. You talk about property and economics, and perhaps not normally talking about individual deals or individual properties, but perhaps, life as a property investor, as a property entrepreneur, a landlord, portfolio landlord on a wider scale. Have I got that right? Am I painting an accurate picture?
You're definitely in the right ballpark, Ant, for sure. Yeah.
So let's kind of find out a bit more then. So let's talk about life pre-property. What was that for you?
Was a life pre-property? Yes, I remember it well. So
Fondly?
I have a relatively academic background, really. I've got a couple of master's degrees that involved a pretty healthy dose of economics, which has come in useful, as you've sort of alluded to already. Corporate-wise, I had 3 years in financial services, a couple of years of which were in wealth management and building portfolios for the ultra high net worths, and then a year as a cross-business consultant for one of the UK's top 10 lenders. So all lots of fun, but I stopped doing that when I wasn't learning anymore, really, to be honest, or felt like I'd hit a brick wall and just had better opportunities elsewhere, I suppose. The rest of that, because I only got serious when I was about 33, I think. The rest of that, I did various different things. I worked pub jobs until I was about 22, 23, I think.
As everybody should. Yeah.
I did it during university, and then I did a bit afterwards as well when it suited me. I tried to make it as a pro poker player, and I failed. I did okay. I started off online. I turned about $50 into 1,600 pretty quickly, and thought I was going to be the next big thing. This was the very early days of internet poker, so it was not a known quantity at the time. But I decided it wasn't for me, or it decided it wasn't for me. You decide. And I'd also, crazy as it might sound, supplemented my way through university by playing fruit machines and winning money on them. So I had lots of tricks and hints and tips to know when machines were going to pay out and things like that. So I was always a bit of a side hustler, as well as having a source of income. And then I also ran a betting syndicate for a number of years as well. None of those were ever, don't get me wrong, I'd love to be a pro poker player. It was a pretty cool lifestyle and all the rest of it. Although with 3 kids, it wouldn't suit me much these days, to be honest. But none of those were ever really long-term prospect things. They were just hobbies that turned into obsessions that got a bit out of hand, really, I suppose. But there was always something beyond the sort of 9 to 5 or whatever you want to call it that appealed to me, I suppose.
Well, when we finish this recording, I'll tell you about my foray into online. I'm not into gambling, but I had an idea once of, like, what if I just did this? And I'll do it off for this recording. It's a funny story, but maybe I'll share it in the pages of YPN another time. So,
Sure.
yeah, I thought I was going to be a billionaire, but never mind. We'll come back to that. So
We've all been there, for sure.
Yeah. So where did property fit into this?
Well, it was post 2008. I was looking at what I should and could put my efforts into. I wanted something that was long-term and sustainable. And of course, I suppose like everyone in many ways, I wanted something where I could nearly guarantee success, or that the dice were loaded in my favour. Although I owned one property during the whole 2008 thing, and that was my accidental landlord. That was the one that got me involved, sort of thing. That was the one that drew me in. And ended up making good money on that, mostly by luck, because it was on a base rate tracker mortgage. So when the rates came down, it was rented out, and it was supposed to be a property to live in, but I parted ways with my partner. We decided to keep the property because we couldn't sell it at a price that was anything like we'd paid for it because of the time. And then it started cash flowing very well when the base rate went through the floor.
I remember that period well. I had one property at the time that was on base rate less 0.5%.
Freebie.
Well, they were actually taking 19 pence per month off of the capital sum. And
Cost them more to produce the statement every year than
and I was renting it for 1,200 quid. And so it was great times, but, definitely not by design. So
Yeah. I'm aware of some who had like 0.75% discounts and things like that. So they were actually getting paid. If the clause wasn't in there not to pay them, they were getting paid every month
yeah,
by the
crazy
bank.
time.
What a position.
Yeah, crazy times.
Yeah.
But yeah, so how do you turn that one property into so that's the kernel of an idea, is it? To say, do you know what, this thing works well. I can do more of this.
Well, I guess, capital wise, we lost money, of course. So it didn't, I kind of put that one a little bit out of my mind, although the cash flow was good. But the broader market, I looked at it and thought, right, okay, well, rents are doing okay. There's plenty of people renting because of the environment, and there will be. And now looking back, I see that I was sort of halfway through a huge wave of growth in the PRS at that time. It was absolutely blowing up completely. But I noticed that with a bit of guile and just buying through estate agents, I was managing to pick stuff up at the same sort of prices they traded at in 2004 in 2012. So I simply thought, well, if I've had 8 years for free here, sort of thing, if you follow that logic, and it wasn't like they were 2007 prices, they were 2004 prices. I thought, well, if there's good yield, of course rates were low and they were coming down, the bond yields were coming down at the time, although the base rate obviously stayed stable for a very long time. Well, what's not to like? There was margin. There was capital growth to come back. It's every time there's been, what did I look back at? Things like what had happened in the 90s, because, I'm an economic historian, I suppose, in these situations. And the way that property had moved in terms of values over the years, it looked like a nearly sure thing sort of bet, really. So I thought, right, well, that looks like it's for me. How do you do it? How do you go about it? Remortgaged my house to get some deposits together, spent them really quickly on buying properties,
There you
and then I
go.
had no money. So then I had to start learning how to do it with no money, a bit of cash flow, but capital was very, very weak. So that's what sort of started me on the road to partnering with people.
Okay, and that was because I'm always interested to see how people do that. I know my journey is not dissimilar to yours. I started just a little bit before, but when I was buying properties in probably 2009, 2010, I was buying them at maybe half of what their peak prices had been, maybe just a little bit over. And then at the time I thought, if I get 20 of these things, and each one goes up by 50 grand, which is what it was worth before, I've made £1 million, and I'm never going to save £1 million because nobody does. And my challenge at the time was probably similar to yours. I had enough money for 1 or 2 deposits, but sometimes I could get all of that back out. Sometimes I couldn't. And so like most property investors, it's just really easy to run out of money. And I think that's where a lot of people stop, isn't it? They're like, oh, bugger, I've run out of money. Now I'll try and save. So for you, it was working with private investors or
so I shared
finance,
equity with people. So my first JV was an equity share. So they provided the funds. I did all the legwork. Found us a nice cheap block of flats. It was a great buy, to be honest with you. These days I benchmark deals by, would you do 10 of them or 100 of them and be happy, sort of thing. And that, if that was your whole portfolio. And that one, definitely, I wish we'd done 10 deals like that. They were great stuff, yielded really well. Planning in 06, built in 07, 08, repossessed in 9, 10. We bought it in 14 or 13, I think it was. And it was at probably 40% of the build cost or something like that. But yielded quite well at the time. Rents have progressed. We backed into it. Was a good area anyway for that part of the country. And rents at the lower end of the unit size have progressed forwards as inflation has pushed up minimum wage and government policy and all that stuff that you know. So good cash flower, obviously newer builds, so fewer worries about longer term maintenance issues to start with. Although now we've had it 12 years, obviously It's like any other building, but structure-wise, it's very solid, and it's a nice, desirable thing. People tend to stay, even though it's one-bed flats, which probably tells you it's quite a nice proposition. And there's very little. Where it is strange is there's not really any one-bed flats nearby, so you either stay there or you don't stay in a one-bed flat, I guess. So,
Yeah.
but it just about works.
And geographically, whereabouts is that?
That's in South Yorkshire, so that was
Okay.
my first block.
And is
Didn't
that
title
where?
split it because the values were too low apart from
Okay.
anything else. But we did end up doing it is on two titles these days because there's a couple of commercial units underneath. So we split the commercial from the resi. A little tip for anybody listening, actually, so that we could so we did it in an unconventional way. So the commercial is written out on a 999-year lease, and the freeholder stayed with the resi, even though the commercial's on the ground floor. So why did we do that? Because it enabled us to get a multi-unit freehold block product for the resi, which was much cheaper than getting a mixed use product. And it's
Okay.
10
Yeah.
flats and only 2 commercial units. Like 85+% of the value is locked in the resi side of the stuff anyway.
Okay. And what do you do with the retail units? What are they used for downstairs? Because retail's an interesting space these days. So
It is. And they're it's kind of like a horseshoe shaped high street where it is. We had a beauty tenant at the time, and then we had a hair salon come and take the other one. And over the years, they've kind of they've stayed same use. They've rotated tenant occasionally, but rent's cheap, and it just takes someone who wants to put the hours in. And there's definitely demand, and aesthetics demand and stuff has obviously gone up in the 12, 13 years we've had it. So we've never had
we're
a
not
long.
in short of we're not in short we're not in want of more nail bars and coffee shops. There's plenty around, isn't there? Like they just so much demand for those products. So it's
And it's a
crazy.
nice new building, tidy
Yeah.
building compared to some of the retail
Yeah.
around there is like it is 100+ years old.
Yeah.
So it looks the part for a aesthetics or similar sort of business.
And so geographically, is the rest of your portfolio in one area, or have you done that thing of, I'll buy in Aberdeen and Falmouth, like what?
If one area counts as sort of Great Britain, then sure, yeah, it is, yeah. But no, I had to make a decision probably relatively early on. Did I analyze things to death and focus solely on specific areas? So I live in quite a low yield area personally where my house is. So it was never really viable, even with HMO, although it is viable these days because room rents have really moved on. But I had to travel. So as soon as I realised I had to travel, minimum travel time really to get somewhere of worthwhile yield was about 30 minutes. So I did that for a bit with the first few and tried one about an hour away. We used to manage everything ourselves in those days. There wasn't a dramatic difference between half an hour and an hour away because I'm not handy, so I wasn't fixing taps and things like that. Same tradespeople were not bothered about covering both locations, so that was all fine. So then once you've been an hour, you think, well, it's not too difficult to go 90 minutes. Turns into, and before you know it, you're in Scotland. That's kind of how it happens, And so rather than saying I only want to be in the East Midlands, let's say, which I've done more in the East Midlands than anywhere else over the years. I like the East Midlands a lot. I still like it from where the incomes are, where the prices are, where the rents are. I still think there's good growth in capital values. I still think there's good growth in rents to come. It's quirky to an extent because you've got no one real big economic driving force. You've got Nottingham, but if you compare that to Bristol or Birmingham or Manchester or London, it's obviously a little way behind. But then you've got some quite sizable satellite city, your Derbys and your Leicesters and things like that. And then you've got some quite populous towns as well that have got quite strong rental markets and are quite cheap on pricing. You've got a real variety, and I guess you do in many sort of regions really, but you've got a real variety of low yielding, very expensive stuff all the way down to 2 up, 2 down, pretty basic stuff, but it yields pretty well. So that's the area that I focused on. And I've got a business partner in that area. We've been working together for about 9 years. It's a great setup. But even we have spread our wings a little way from there and gone into Lincolnshire and things like that. But the other locations are more driven by where the deals are and or where the people I've connected with can put me in touch with deals. So these days I deal with people who trade nationally, so it could be anywhere. I still don't really buy in the southeast because yield-wise, it's very difficult to make my business model work. And certainly London is just out of the question with the interest rates being where they are because I use leverage, pretty self-evident. Same way that Bristol is not really on the cards, apart from maybe the cusp of Bristol, but go further into the southwest, or if you're dealing with you can't go to Exeter, you can go to Yeovil, you know how it works.
Yeah, I'm just outside of Bristol myself. I own no properties in Bristol. I've got a few 15, 20 miles south in Weston-super-Mare where the prices are really different, and I've got quite a few down in Plymouth as well where the yields just work a little bit better.
Yeah,
and
we've got some stuff in Plymouth, yeah.
So what would if it's not too rude a question to ask, what would the portfolio look like in terms of sort of size and makeup now?
So
Well, it is a nosy question, but that's my job.
Not. Look, if you were bothered, you could look on Companies House. So I might as well tell you, right? It doesn't make any difference. A little bit over 600 units geographically, about 150 in Scotland, about 30 in Wales. We've largely sort of divested away from some of our Welsh stock because I have real concerns over Rent Smart Wales and the direction of travel there, even as a bigger size landlord. Yeah, I could tell you a story about that, but it'd take too long. One particular example from Rent Smart Wales, when they were completely wrong, and it just made me think, if this is the direction of travel, I got involved in Wales because I had a great contact at the time and I thought prices were going to really move. Prices did really move. My contact moved on, so I wasn't able to get in at the great prices. Rode the wave during COVID, where Wales did do very well, up 30 odd percent, and then just thought, well, am I still as bullish on Wales as I was in, say, 2016, 2017? Not really. So therefore, sell and redeploy, repurpose. The best bit, what we do best is buy. That's how we make the most money on completion day. Then we've got to do all the rest, which is sometimes a hassle, sometimes not. And then we trickle along while we're managing the asset. But
And
we normally bought good value day one.
So you're looking to buy keenly day one, kind of.
Yeah, I mean, the brute force way is just cheap, motivated seller, classic old stuff. It might be that we're adding value in a number of different ways. And that's evolved over the years, because these days, for example, having a tenant in situ can so seriously damage the value of a property versus vacant possession. And the market, the landlords who are new to selling or don't sell much or have just got small portfolios, they don't realise till they've whacked it in an auction and it would get 140 grand on the market with a bit of a touch up, or it needs a good touch up and they haven't got the money to put into it because, unlike most people think, they're not sitting there on pots of money. The average landlord is not making a big profit, and or they've spent it over the years anyway. They've lived off the proceeds. And, it's trading at auction at 90 grand, 95 grand, something like that, with a tenant in situ who's inevitably paying half of what the market rent is these days. And people just sort of, they worry about those situations like they're a bit too thorny for them to deal with. But those are some of the things that we've been, so that's a different value add where we'll often, in a nice way, and especially when we've got properties around and about, we'll say to the tenant, look, number one, quite often they're not compliant, these tenancies. So then there's no option there, But when we often get the previous landlord never did any work, which is quite often the story that we get, and that's why it's been lobbed into auction. And it's like, well, it's kind of what I call the gold-plated Rolls-Royce conversation. You can have a gold-plated Rolls-Royce as long as you pay for it, sort of thing. So where do you want, you'd like a new kitchen? Well, I guess we'd all like a new kitchen, but if that uplifted the rent to here, how do you feel about it now? That sort of thing. So we then are effectively then managing the asset on an ongoing basis, and rents do go up, but you were sitting non-compliant, mouldy, whatever else the problems were. Now you're not, but the market rent is here, and we're still raising it to here, but you were down here. And I think maybe some people avoid those because they worry that the tenant's not going to pay or this or that or the other. But there's huge discount. There's huge discounts for solving those problems and taking them on.
I know I've been guilty of it myself before, with some properties. Say, oh, do you know, I'm just not going to rock the boat. They've been in there a long time, and actually, it was the stupidest thing I ever did. Because whilst interest rates were really low, I was like, well, that's fine. I'm making 500 quid a month on it. It's a single let. It's no problem. Then interest rates changed, and suddenly I'm really not making that. But I can't go back to them and go, yeah, your rent's going up 350 quid. So just, it's score, which I should have known, should have thought about. But
majority of people did that. So I wouldn't single you out for any of that. Majority of people.
Yeah. So and predominantly single let properties and single units, or you mentioned just now about the kind of block, where you get the economies of scale. Is it kind of a bit of everything there, or?
Yeah, so we still buy single units to this very day. A good edge on single units, I think, with the methods that we employ, have bought and do buy blocks of flats, portfolios, whole limited companies that own property assets. I've bought a couple of trading businesses as well. So quite an extensive level of what we'll get involved in. And yeah, single let was the vision to start with. We live in a world today, as we're recording this, where the classic sort of 3-bed semi single let by a nice school probably doesn't yield enough for it to be held as an asset anymore, I'm sorry to say. And that's half running costs and compliance. Well, no, it's probably 20% running costs and compliance and 80% where the price of the interest rate is. So, of course, you can hold it if you're at 30, 40, 50% loan to value, depending on where you are in the country. But you can't buy another one without a gigantic deposit, apart from anything else. And so I don't know how you're supposed to deal with that, really. So we have moved more towards either smaller units that are in blocks, or we've moved to registered provider tenancies as a rule, who might be dealing with any of temporary accommodation, homelessness, ex-drug dependency, alcohol dependency, non-violent prisoners, asylum. We've been involved in all of that over the period of the last 10 years, but we've increased that a fair bit more since COVID, particularly temporary, because I think of all the sectors that need help, I think temporary is the one. And so it has a good amount of social purpose, and that makes me smile in the morning. I know landlords never win any knighthoods or whatever, and I'm not pitching for one, don't get me wrong, but I do like the thought of helping on that side of things specifically.
Yeah, so that would be kind of temporary accommodation, emergency accommodation for someone maybe kind of facing homelessness, or that would be the
so
case.
we don't operate it. We lease to providers who are yeah.
And I'm assuming those are now private providers rather than a local authority, I would imagine, or
they're either for-profit RPs or they're just private companies. Yeah, absolutely.
Yeah. Okay. It's interesting, kind of segue into that from single lets, because single lets are bloody difficult to get to work now, but still providing a valuable home for someone who's very much in need of it. And partnering that with a business as well. It's not just 100% altruistic investing, is it? This thing needs to make money as well.
Absolutely. Well, look, whether anybody, I think I've upset a few people over the years, not deliberately, but since old Georgie Osborne's budget in 2015, it kind of overnight became a business. And every little nip and tuck and scrape and scratch since then has driven it more down a business route. And I think that was deliberate. I think he pretty much said that at the time. And all the lovely landlords that you've met over the years and I've met over the years that are actually really caring people, they don't want to rock the boat. Like you said, they're not greedy people. They haven't gone, right, I can put the rent up this year by X, so I'll squeeze the tenant. I'll squeeze until the pip squeak sort of thing. I don't know any that I've met who operate like that, to be honest with you. I know that's the shelter viewpoint or whatever, but it's just not really the truth. And unfortunately, a bit of that's backfired, like you say, because such a sudden rise in interest rates made so many things unviable, or you've got to whack the rent up by 500 quid or whatever. But it's impossible for it not to be a business. And you can still be an amateur playing at the business side if you want, but be careful because you can't opt out of the compliance. You can't opt out of the renters' rights bill. You can't do all of those things. I'm not suggesting people get worried about it. I don't think they should be worried about it, but they've certainly got to be aware. And the management side is tight, and there's, even from only sort of, as I say, ramping things up in 2012, the difference between, oh yeah, do a gas safe, to scrutinise the EICR to see how many years the electrician has given you, and all the rest of the things you need to think about. Some of the things we've had to do with EnviroVent or new air systems and things like that, when people are not even venting their tumble dryer or whatever, pretty frustrating and expensive. And then the tenant unplugs it, which is this disconnect between where people think landlords think and how people. And look, if you take out the really nice, I know lots of ladies with 3 properties, 5 properties, 7 properties who do everything themselves, and they really provide a wonderful service for their tenants, right? I don't know why they're all ladies, these people that I know, but they are. And I just think, well, if they looked at that from a commercial perspective, they wouldn't do all of those things. They're doing it because they care. If you force them out and bring in the court, and so instead of 500 with 3 properties each, you get 1,500 with one company that is a fund. Just do you think the service will be better or worse? The clients will be better or worse? And I genuinely think there's a big disconnect between the real world and what Westminster think in these. I know where my money will be, and they'll get a rent rise letter 4th of January every year, CPI plus 1%. Thanks very much.
Yeah. And, if they miss a payment, that's it.
Straight to recovery.
I've always been pretty understanding and flexible, going, do you know what? Like, I know things, get difficult at certain times of the year. We'll work it out or whatever. Sometimes that's come back to bite me, but most of the time it's worth that. It does feel strange times at the moment. It feels like, no, it doesn't feel like we are, we're kind of unwanted. Private landlords, particularly kind of small scale landlords, anyone with 3, 5, 10, 20 properties or whatever it might be, we're definitely kind of being squeezed out now. They don't want us. They want the big boys, the big corporates. And so one of the questions I'm asked all the time, and am asking all the time, is there still a place for the small scale landlord? Do we still fit in? And if we do, what does that look like, and how does our role change? I'd be really interested to get your take on that.
There was an interesting, of the larger organisations that publish research, I think Hamptons International do a pretty reasonable job. And they did a piece on this about how many limited companies have been incorporated. But also, if you drill down into that piece, they talked about how many have got like 3 or more directors these days. So instead, people are joining forces, forming multiple shareholder, multiple director companies. And I've been involved in a couple of them myself, but there's actually sort of maybe 3 directors, 6 shareholders in total. And they're joining forces to do that rather than have their own specific limited company. So we'd rather have 6 in one company between 6 of us than us to have 6 companies and have 1 each, sort of thing. So there's definitely a push towards that sort of thing as well. And there's been lots of startups over the years, although I haven't really seen any gain as much traction as I thought they might do, who fractionalise properties. So you can buy a share in 23 Acacia Avenue with a yield or whatever, and you can put 100 quid into a property rather than that not be available to you. So, I mean, you can do that with REITs, obviously, to an extent, but it's not everyone's cup of tea to be trading in REITs that are trading on the alternative investment market or whatever. There's quite a high barrier to knowledge entry, apart from anything else that scares most people. There's definitely been a push to, I mean, what you said in terms of, I think it's been an active government policy to push people away, and Labour were never going to change that. It was a surprise that it came from the Conservatives. I would argue it hasn't really helped the tenant that much, but I think we're in a period of transition, and that period of transition since the 2015 budget has been far, far slower than I gave it credit for back in 2015. And we've got another 10 years of transition, probably, maybe even more. And it's only at the end we'll look back and go, tenner better off? No way. No way will they be, but that's the direction of travel.
It's really challenging, isn't it? Because, I've seen what's happened to my rents, as properties have become vacant and been refilled, and they have increased significantly, and through lack of supply more than anything else. And I was chatting to someone the other day who works in one of our businesses, and he said, I'm trying to rent a house at the moment. Guess how many 3-bedroom houses there are available in my town right now? And he went, none. There's no 3-bedroom houses in a 30,000 sort of population town. They're all gone. I was
Exactly
like,
the ones that I said don't work anymore, right? Because
yeah,
people look at the numbers and just go, sell it.
yeah. Yeah, and even the kind of 1 and 2 bed flats, which I have more stock of, they hit the market and they're gone straight
Yeah.
away, and people are
60
competing on them.
inquiries overnight and things like that. It's crazy.
It's crazy, and so ultimately tenants have paid the price, I think, for this kind of, I don't know, were they at the heart of the kind of government thinking of these are the people we're trying to protect? I don't know.
Westminster does not understand this stuff. Like I've said, I would love them. If anyone anywhere near Parliament is ever listening to anything I get interviewed on, you can come with me for a day out, bring your security detail and your chauffeurs and whatever, and I'll take you wherever you want to go, and we'll see some real world rental stuff in parts of the country, and it will really open your eyes. I promise you.
Yeah. I guarantee they're not going to take you up on it,
I know.
unfortunately. But
Be a good day though. Be a good
it'd
day.
be a great day, yeah. So what does like property investing look like for you now? Because it sounds like you haven't just built a portfolio in 2012, 2013, 14, and then stopped. It sounds like you're continuing to kind of grow. What does a deal look like for you now? So when you look at a potential individual unit or a block, what is it you're looking to achieve? Because sometimes we're saying, do you know what, I want this to be no money left in, and it's a 2-bedroom flat, I want to make 300 quid a month on it or whatever, or I'm happy to leave 2 grand in, but if I get my money back in a year or 2 years, I'm happy. What are the criteria that you're looking for, having kind of refined it, I guess, after 600 plus kind of deals?
Yeah, and I think it also depends based on sort of where we are in the cycles. A couple of months before the budget, I spotted that the chap I'm talking about last year, 2024. I spotted how negative the chap was and thought, right, there's going to be a significant disposal here. And so it was absolutely party time at auction purchasing. Bought more than I would have thought that I would have done, certainly far more than the average September and October, but because the opportunities were there. So there's an extent to which it depends on the overall position, because the operation is still pretty lean, and it's not like you can go hiring people left, right, and centre because the margins aren't huge. So you've got to have multi-skilled people who can work across different levels of discipline. If we've got 100 refinances to do in 6 months, there's a lot of admin needed to do all of that. There's also the admin of running the portfolio anyway, but now those 100, in the 6 months after that, we're not going to need to do 100 refinances, but we might. And one of the things that's changed, and changing to 5% additional stamp changed it as well, is, it takes another 2% out of a deal that wasn't necessarily there. So just from a basic economics point of view, you've got to pay less. You're probably not going to be able to pay another whole 2% less. So you're going to leave a bit more money in, if that's what, or you're going to take less out, or however that sort of plays out. You're going to do fewer deals than you were anyway. So I'm not kind of obsessed with getting money back out, but I do like the sort of get your money back in 2 or 3 years. I think 3 years is really the absolute top that I want to be looking at. But having said
So
that, I've done deals this year where
after you refinance, any money left in, you kind of be saying, do you know what, I want to get that back in a couple of years, really. Yeah.
But I've done deals this year where they've been quite creative and there's not a lot of money down, or, vendor finance pretty much. But I'm probably not going to make any money out of those, well, maybe for 3 to 5 years. But it's time and effort in, not money in up front. And risk is low, effort is high, rewards are good in the medium term. That's pretty good at a time when, if people are selling stuff, they're getting some pretty snippy offers from some of the traders, and some pretty bad news out there from, I see some of the stock that comes up where people are trying to sell stuff they bought in 07 at inflated prices, and they're still not back to where they were today. So it's difficult out there. There's a lot of stuff quietly on the market that isn't on Rightmove or in the auctions or whatever. But that means there's a lot of opportunity to be exploring as well. But I think that you have to take, oh, well, I would say this because I do, right? But I think you have to take a view on the interest rate and where it's going. I've largely called it correctly for the last few years and have acted accordingly. What that's changed is it means selling off a few more bits. So we've now sold over 100 units in total. And if you'd asked me 7 or 8 years ago, I'd have said, we're never going to sell anything. We don't sell stuff. Why would we sell stuff? But you've got to, in order to refresh the stock a little bit. As I said to you about Wales, I've started looking at things and going, do I want to own that in 5 or 10 years' time? Why not? Okay. We're not attached to any of them particularly. It's become vacant. Okay, there's a 2% early repayment charge on the mortgage, cost of doing business. Get it on the market, get it away. And a lot of people would see that as a big win. You know, your friend, you were saying no 3 beds. A lot of people see that as a win because the 3 beds that there were have been sold to first time buyers. But they don't realize that some people want to rent, need to rent, not because they're financially constrained into renting. Perhaps they've got a new job. Perhaps they want to try something out before they commit to buying a house with a partner. There's lots of reasons why people rent that, not just financial trapping, you know.
There's good reasons why some people will never and should never own a property. You know, it doesn't get said very often, but it is the truth. And
Yes.
I wanted to ask as well, this kind of selling off of stock is interesting because as a smaller landlord, if you've got like, let's say 5 properties or 10 properties, you probably work really hard to get that one property. And there's a kind of emotional attachment to it. I think sometimes there can be a reluctant to sell because I worked so hard to get it. And I wonder if, you know, when you get to the kind of the size portfolio you've got, if that's all gone, it's just numbers on a spreadsheet now, or if you still, was there a point where you kind of felt the shift there, or did you never feel like that? You never had the kind of emotional attachment to, you know, 10 Acacia Avenue or whatever it is?
It's a great question. I feel like I've always felt like this, but now you ask it like I'm not sure if I have. But I believe that a home, you know, it's the people inside it that make it a home, whether it's a 1-bed flat or a mansion in Bayswater or whatever. So the bricks are just the bricks. And the same way you shouldn't feel a property's unlucky if you have a bad tenant, particularly, is the same reason why you can't be attached to any of them. Now, I'm lucky these days in that I have people working with me, for me, who act as a line of defence between myself and the tenant, but we still try to be human and compassionate in what we do. We also are not that impressed when someone's mum has died 3 times on the trot, because we know it's not
unfortunate.
True.
It's an unfortunate thing for somebody.
There's bad luck,
that's bad
and there's
luck.
that, isn't there? But the third time, you really know there's a fine line, and you can't be too much of a pushover, obviously. And we are commercial about rent chasing and arrears and things like that. We absolutely, the bank doesn't wait, as you well know. And the biggest, still to this day, the biggest holder in my portfolio is the bank, or a number of banks. So ultimately, I still do work for them to an extent, one way or another, and we need to be mindful of that. So there's a tilt towards. It's difficult to make your 3-bed semis work at 75% loan to value, as we said, but they might work at 40% if you want to hold on to some of them. So you've got to sell some off to get the mortgage rates down, or you've got to sit and wait for 15 years, 10 years, however long that's going to take. You have to think about it like that. But I'm certainly, the numbers on the spreadsheet in terms of the bricks, absolutely. You know, our best day is buying. Our second best day is selling in terms of the amount of money that changes hands and turns over. So, you know, depending, if you run a model over 10 years, 15 years, 20 years, the longer you go on, the more percentage of your returns come from the capital growth. We went through that period, as we said, in the sort of 20s, where there was a lot of cash flow, generous cash flow. Some of us were generous with it and kept our rents down and things like that. And the trouble is, we kind of kicked a can down the road. None of us really thought interest rates would go back like that. We were told they would sort of manage them back upwards relatively slowly, but it never happened. So I think you've got to be pretty dispassionate about these things because and you've got to put your family's needs first ultimately when it comes to. But like I say, a lot of people who are anti-landlord are delighted to hear of a landlord selling. And I must say, I find a lot of fulfillment in selling to a first-time buyer, but it hasn't helped the PRS, right, to go -1 unit. Almost everything I buy was already a rental property or empty, right, or derelict. I don't really buy anything else. So I'm
I've always,
either
I've always said
creating 0 units or
you're not,
-1.
and you're never competing with a first time buyer or
No,
someone kind of upsizing because they've got to have a much smaller deposit. They can afford to pay more money. They've got, the love of the property kind of, with the aspiration pushing all that, what they'll pay up for it. They're always going to pay more than us, I think. So I never really get this kind of landlords are taking stock out of it. They're competing against first time
no, but
buyers.
I do accept that some landlords, especially more amateurish but
Yeah.
wealthier professional landlord, people who work in professional services or
Yeah.
doctors, dentists, things like that, I do accept that they would have taken units from the PRS. I just think I've never competed with the first time buyer for all the reasons that and usually I'm solving a problem they don't want to solve. They couldn't fund it if they did want to solve it anyway, or they don't know how to solve. So that's the thing. But the more you tax the flip, for example, flips now become, with 5% stamp, they're extremely difficult.
Yeah, really, really difficult to get it to work now. I was going to ask about that. Have you switched lanes into kind of development? And you mentioned flipping property there, or have you kind of stayed in the lane of like investment, build the portfolio? Because I've personally sort of at times I've moved into sort of development deals and with varying successes and amount of love for it. You said earlier on the best days of the day you're buying and the day you sell. That was definitely the case with the developments I was in. Everything in between was awful. So have you kind of migrated into like development and stuff, or would you just say, actually, do you know what? I know investment, I know how to grow a portfolio, we'll stay here.
I would say my development experience almost entirely mirrors yours. I'm glad I've got them when I've done them, but I didn't enjoy the process and varying degrees of success. And when I look at some of the investment deals that I've done, and day one, I've saved myself 2 years of blood, sweat, tears, effort, and all the rest of it. I just think, why would I bother? I mean, I've tried to buy investment property at development levels of returns. So that has suited me far, far better. And not
So can
always
you
as
can you
easy as
can
all
you
of that, but
explain what that's really? Can you explain what you mean by that though? So by investment properties at development level returns, what does that mean?
yeah. So if you traditional development, you'd be looking at a 25% margin, depending on which way up you're measuring it on cost or on GDV or whatever. But a traditional BRR, you're looking for the same sort of margin anyway. I'm looking at, is it already there on day one and the price is low for a reason? So I bought a block some time ago, for example, where the wrinkle was there was council grant funding in there and it was quite quirky. It was sort of 50% let to local authority tenants, 50% short let to contractors. More down where we were talking southwest in Bridgewater, this is. And day one, after we got a nice surprise on the valuation, there was a 25% discount. And there was already running yield. They'd done the development to a good standard, great EPCs, all the rest of it. And I just thought, well, I don't know if I'll ever do another development again, to be honest, because that's the same margin in there. But I think people don't necessarily understand how important time is in development and how much it can kill you. And that's the kicker, really. And time is everything. And unless you are great, and people don't realize, you lose someone doesn't turn up that day, you don't lose a day, you lose a week. You don't lose a week, you lose a month, and the whole project schedule can be thrown out. And it's difficult stuff to do.
Yeah, I've got a couple of friends of mine and they're quantity surveyors, and I was really, really like moaning about the development deals that we were in. I was like, oh God, I'm in this meeting with their quantity surveyor and he seems just determined to push the kind of price up. He said, oh yeah, it's awful. It's like being a marriage guidance counsellor during the world's worst divorce on every single deal, on every single project that they're in. So yeah, I didn't love it. I loved some elements of it.
Yeah.
But
Yeah. I like the end product. I didn't enjoy the process too much every time I've done it, really, to be honest.
yeah. So I wanted to ask as well, like, overall the experience of buying, as many units as that, have there been kind of mistakes that you look back on, like that you've learned from, that you said, actually, do you know what, if I'm going to share this and other people are going to learn, we learn as much, more from our mistakes than we do our successes quite often. So can you think of any of those that you thought, you know what, I would never do that again, or I got this wrong, or,
Yeah, I think the best general one that there's loads, we could do another hour on that quite easily. The best general one is to do with leasehold these days, I think. And I don't deal in leasehold anymore unless the freeholder is so I'm talking about a single flat rather than a block, obviously, unless the freeholder is a local authority or a decent size housing association with a decent rep. Because individual private freeholders, bearing in mind my stock in trade is cheap stock, if you have an issue with a 30 grand flat, a 60 grand flat, whatever, you've just got to sell it and get out of there, right? And probably at auction, because there's just too many problems to deal with, right? So don't get involved in them in the first place, regardless of how cheap they look, right? Because they're problematic. And when there's a section 20 or something like that, so there's a major works notice, you've got very little control or no control. And even when you know what the right thing to do is, I mean, we know what the right thing to do is in terms of the law, but do you want to litigate for 3 years while you've bought a property on a bridge that you just want to get onto a term mortgage or get away from? So don't buy leasehold unless you can tick those boxes. And I think a lot of people don't like local authority because quite often maybe the block hasn't been well looked after or whatever. Now, as long as that's priced in and you know if there's a new roof, despite the fact you think it should be 20 grand, it'll be 50 grand. As long as all that is priced in, you're all right. You can get there. So that's probably the biggest and easiest one, because I know people often get tempted by flats because they can look very cheap and they can, on the face of it, look like they yield fantastically well. But you've got to look at the ground rent clauses, you've got to look at the service charge clauses. And if it's a small, quirky little building, people don't realise, again, a freehold of a 100-unit block in London is worth a few quid. Even in today's world where new legislation and unproven, uncharted territory new legislation is still worth a few quid. A 4-unit, chopped up old Victorian house in a place where prices are £250 a foot in the open market, that's not worth any, that's negative value, that freehold, because you've got to manage it and you're not going to make any money out of it. And you're going to have trouble collecting ground rents. You're going to have trouble getting insurance paid. You're going to have trouble with that whole thing. So stay away from those buildings because they're not worth it unless you can buy the whole thing in franchise, things like that, if it's worth the time and effort. But if you've got a bad freeholder, keep them out of your life is what I would say. So that's probably my best one, if you
I
like.
mean, that's brilliant advice. There's so many of those smaller ones are kind of like poorly managed. The administration is non-existent, and just to kind of, I guess, even when they're owned externally, there's no communication. I've had instances where I was like, I don't even know who the freeholder is. I don't even know how to contact these people. It's just, yeah, really problematic. So if you were starting today, so 600 plus units in or whatever, if you had to start again today, what would that look like? And would you do it the same way, or could you get the same results faster by doing it differently? How would you begin now?
Yeah, it's a great question. I think so. What I did do, I told you about that block earlier on in South Yorkshire and a few sort of buildings that have been converted to 2 flats and things like that. I also did a couple of professional HMOs quite early on. Standard was nowhere like it is today. And they were great for cash flow, but headache for management purposes. Didn't really enjoy that very much. Whereas the opportunities today, I think a lot of the opportunities lie in the enhanced rents that providers are paying. And there's still a lot of, like there is in property, you'll know YPN will have reported 6 times on every buzzword as it's come up and down over time. It's inevitable, isn't it? Right. And social housing, you might be able to tell us when the first time you started talking about that more commonly, but it's become much more viable in this world because the the technical nerdy reason is by freezing the LHA rate in a time of rents rocketing, providers have had to start working on the basis of market rents rather than LHA rents, because otherwise they'll just get no property whatsoever. Now, for reasons that I won't bore everybody listening with, I did some analysis and I worked out that when the providers are negotiating at market rent, that's actually corresponding to about the 85th percentile of the of the rent sample. So for anybody who doesn't know or doesn't remember, HA used to be set at the 50th percentile, and then over 10 years ago, it was clipped back to the 30th percentile of rents. But today they're negotiating at the 85th percentile, so drastically higher than they were for contracts that are years long, sometimes have a inflation protection in the rent side of things, no voids, no credit risk to speak of. I'm not saying go off and work with any old provider. You have got to due diligence the provider. That is the absolutely key part. But if I was doing that today, the amount of cash flow that some of these can generate, we're getting stuff sometimes that is yielding 15 and 20%. I'm cherry picking the very best examples there. We're not getting that every deal, right? But we are doing deals that are yielding 15 and 20% sometimes. And those yields are so good, even if you've left quite a bit of money in, you haven't got a long payback period. Once the payback period's completed, you're obviously putting some pretty good numbers in the bank every month. And the only real thing I think you need to worry about is whether those units still work at market rent, which inevitably they probably do. If they wash their face at market rent, you can take the risk. Don't overpay for them, absolutely. But I think I would be getting stuck into that even more than I already am, because it would help you build those blocks of equity plus cash flow. It's cake and eat it sort of stuff at the moment. And I don't think there's many people doing it very well. I hear the fanfare, but I don't see lots of, unless you're going to tell me YPN's done lots of great case studies of people doing this sort of stuff already.
We've done some case studies with some people who've done some incredible kind of 1, 2, 3, 4 deals, yeah, where they've worked really closely with one or two kind of social housing providers, I should say, and then they've kind of gone out and shopped for the property to fit that, where sometimes it's a very niche, particular property that they need, and they've got really good at that. But I've not really met people who've done this on a really big scale. Know a few people who are talking about it now, but quite what that will look like, whether they're going to build purpose-built blocks of flats for a provider, maybe, I don't know.
I think you see that more in the sort of supported space where they need specialist stuff, and those can be magnificent sort of deals, but those are things really that you need to develop.
Yeah, those, and they're like unicorns, like I've found this. Whereas I think what you're talking about is actually there's a demand for that kind of temporary housing for lots of different types of stock, actually. And so you could go looking for a 1-bed flat or a block of 10 1-bed flats, let's say, because you don't want to buy a 1-bed flat with unless you're the freeholder. So, or it could be a detached house or something like that. But it's got to work on the numbers. You're not going out shopping for the particular type of property that they need. Am I getting that right? Or
I think so, pretty much. I think that's a pretty good pricing. I mean, I think there are a lot of providers don't necessarily work outside of their own stock anyway, but the ones that do, they're often reacting to contracts that come and go, and there aren't long lead times to fill them. So the more you've already got, the easier it is, because you can give them the portfolio and say, look, I'm not going to chuck anyone out, but if someone organically leaves, do you want to hear about which postcodes do you want to hear about? Or they send us a list once a month about updated areas that they're looking at. We will also buy to order, and because we do trade fairly fast, auction probably being the slowest way in which we trade in terms of buying, because we buy a lot of stuff from traders who are moving very quickly as well, we can deliver a unit relatively quickly. We might be a bit slower on the ground because we're usually not round the corner and on the site every morning. But in terms of the actual acquisition process, we can be very, very quick indeed. And they know we'll do what we say we're going to do. So there's more of a longer standing relationship. And like everything, it's a people-focused game. And if you build those relationships, when they need stuff, they know they can come to you. What we've had as an added bonus to that is some providers we've been working with for years will come to us and say, look, Mr. Jones wants to, we had one the other month actually say, Mr. Jones, not his real name, wanted to sell. He needs to sell these 2 properties. Now, don't tell him, because we're only paying him 700 quid a month. But if you buy them and do a little bit to them, we can give you 12.50 each per property, which really stacks up very nicely. So there's now, why have they done that? Well, they know we won't kick him too hard on the price, and they know we can be trusted. If we bought them from them, we're not then going to chuck them out. We're going to keep them in, and they know we can do that again. And we've done that a number of times. So they've actually provided a source of a few leads for us as well. So I think I should probably stop talking about it. It's probably too good to share with everybody. But I think that's what I would try and get into. But don't underestimate. I should qualify that. There's a huge amount of legwork in building the relationships with the providers, or going through someone who's got an existing relationship with the providers to see how they work and to make it worthwhile. The people I know who are doing really well at it have put in hundreds of hours on the phone and networking, the political side of it, all the rest of it, So there's a skill set there that's probably different from a development skill set, for example.
And how would you overcome the problem of running out of money if you were starting now? Would you do that in the same way? Would you kind of, I guess when you started and you quickly run out of money, right, I've got to find individual investors to work with, whether it's, equity or debt finance or whatever. It can be a lot of legwork and kissing a lot of frogs, I guess, at that point as well. Would you do it in the same way, or would you have a different plan to fix that?
Yeah, I mean, if you share equity, you've got to work. If you share 50-50 equity for the sake of keeping it easy, you've got to work twice as hard, because you've got half a property, even though you might be you're inevitably the one doing the legwork on that one property. So you do have to think about it from that perspective. But if you can do 3 deals when you only would have been able to do 1, that's the flip side of it. So I don't think there's a necessarily a yes. I mean, what can you do? If you've only got a deposit to start you off, you've got to be pretty careful about what you do. Buy pretty well. Maybe look at buying on a mortgage and then a further advance, because you're going to be able to do something that's going to fit within the criteria of everything. It's possible to do. Or if you've got a decent chunk of money, you can buy one property with cash. You're your own bridging lender to start with. Do the first one as a proof of concept. Try and get the money back out. Don't be too obsessed with it, because, like you said, if you can get the money out within a year or 2, you've got the vast majority back out. Rinse and repeat. That can still work. And then the further leverage strategies, I think it depends on your level of risk appetite, sophistication, to an extent, work ethic and things like that. I've had this mentality, like I said, where there's stuff I'm involved in at the moment where I'm not going to get paid any money for 5 years. That wouldn't be everyone's cup of tea. And I think there's probably some people who listen to this thinking, well, why are you bothering doing that when you've already done so much? I enjoyed the deal. It helped someone out to do it. I couldn't resist the fact we were putting very little money in. That was it. I don't mind. I don't need to wait for that. I don't need to get that gratification now necessarily. So the hard thing is, the more you've got, the easier it is to do deals, because the more comes across your desk and the more people will trust you to do deferred consideration things, vendor finance and all those sorts of things. So there is a bit of a trade-off there. But what would I change? I mean, it took me about 5 years to use a bridge, right? Because I was scared of them. And I wish I hadn't been so scared of them, because I'd have done more early on, in the times before 3% stamp duty, in the times blah, 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 all the rest of that. So I would use bridging more quickly, but I wouldn't recommend bridging for people who are particularly nervy, or I would make sure that what you're buying has got good income, or income that you can fix very quickly to cover the bridge. Make sure you can cover the bridge from a servicing perspective.
Yeah. Okay. Brilliant. And the next question I had for you is slightly different, and I hope that's okay. I wanted to ask what life is like as a portfolio landlord. Is it when you started out and you had a vision of, this is what I'm gonna do, maybe this is where I'm gonna be? Is it what you thought it was gonna be? Do you, and as part of the same question, do you still take time for you outside of it, or are you kind of like workaholic? head always in a spreadsheet or looking at a deal, or do you enjoy the flexibility that property affords? And if you do, what do you do in that time? What's life outside of property look like? So
Yeah,
sorry,
I definitely enjoy the
a long question
yeah,
there.
but great question. I do enjoy the flexibility very much, especially the ability to be more engaged with what my kids are doing these days. That's fantastic. But I still put in some pretty serious hours, and I'm often writing articles in the early morning on Saturdays and Sundays, which doesn't detract from family life because no one else is awake apart from anything else. And so that's quite handy.
How old are their kids?
So they're 14, 11, and 8.
I have 15-year-old twins, and these teenage
Right.
years, they're fun, aren't they?
Yeah, they are. And there's there's lots of dad's taxi and other stuff, fun stuff to do these days. But it's good because that has made me get away more and be less obsessive and things like that. So I think you get good at compartmentalizing these things. And also, when you realize at some point in our life, we all realize we're not going to be Elon Musk or Larry Ellison or whatever. And we get a bit more relaxed about, well, because again, some people say to me, why do you carry on? Why don't you just stop buying? But my point has always been, well, once you've created the system and it works and you're still refining and it's getting better, why would you stop? It's not about greed, right? It's about turning the handle. Plus, I employ quite a lot of people these days, one way or another, in various businesses. I take that responsibility pretty seriously. So they need a leader. They
I
need
think
need to, have
it's also
someone
a,
at the front of the helm.
and it's also a question I think someone would ask who probably hates working and doesn't enjoy what they do, rather than, you're maybe choosing to do this rather than having to do this, and
Yes,
it's quite a different thing.
it is. It is.
So apart from dad taxiing and dealing with three kids, what does kind of spare time look like? What do you do for fun
Yeah.
apart from
So
look at spreadsheets and write economic articles?
there too much of that probably for
Yeah,
most people's liking. Yeah, very much. But I enjoy trying to take my own view of things. I enjoy reading the source data. I really do like trying to theorize. I'm not really too led by what I read from other sources. I like to come to my own conclusions. So I do enjoy that side of things. In terms of sort of leisure activity, well, most of mine are intertwined with the kids. There's no two ways about it. I found real joy in what they enjoy, and that's good fun. So whether that's a bit of time, my oldest loves his gaming. So whether we do a bit of gaming together, my middle one's obsessed with his 10-pin bowling, and he bowls to a very good level these days. He's the England number one under 13. So there's lots of travel and lots of stuff involved in that. And my little one, she enjoys music and she enjoys her reading. And girls are just different from boys anyway. So I enjoy all the bits of time we get to spend together.
that's nice. I mean, it's great to get that balance, isn't it? And the
Yeah,
fact you do
yeah,
get to spend the time with them.
yeah.
The other thing I wanted to ask, and you can feel free to not answer this one, is in the world of kind of property, IPN kind of spans like property education and property information and property investment. What do you hate about it and what do you love about it?
It's a really good question because I used to hate the education side, but I did realize after a while I was getting quite jaded because all I would hear about is stuff that had gone wrong and I wasn't hearing about stuff that went right. So I had a bit of a biased viewpoint on the whole thing. I still get uncomfortable sometimes around some of the marketing and the sales puffery that I see. Anybody who's not saying, look, this is hard. I'm not saying it's not worthwhile. It's definitely worthwhile, but it's hard. But nothing in life that's worthwhile is not hard. So that's just life, right? So I'm still uncomfortable at some of the sales techniques, but I'm a lot more comfortable in that space now, especially as there's such a huge demand from people wanting to learn, which would be one of the big reasons why they read YPN, right? That's the thing. That all makes sense. If you want to learn, you either learn from your own mistakes, which is more expensive and takes you longer and all the rest of it, or you try and learn from other people's, as you said earlier on. What do I love about it? I still love the deal. It's not even whether it's a 20 grand flat or a £3 million block of flats. That I don't get 50 times more fun out of the big one. I just love doing the deal, making the deal stick, getting it over the line, pretty much lose interest at that point, to be honest. But still love that process from end to end. So that's why I've done it so many times. I think really, I still do love it.
Well, what a brilliant answer. I like you. I think I've enjoyed doing the deal. The crap at managing properties, definitely not my forte. I've always been glad to like hand over the keys to someone and say like, make sure you do the admin because I'm shit at that. It's interesting the kind of thoughts on the sort of property education side of things as well, because there are some amazing people that I've known for nearly 2 decades now in that world, and then I've also seen other people kind of come and go, and some of those have not had their clients' best intentions at heart at all. And it's really difficult because you kind of, everyone gets lumped into the same bucket. And you think there's some people who are brilliant at what they do out there. And then there's someone who's bought 2 properties and is setting themselves up as a guru and maybe borrowing money and not paying it back. And those things are really difficult to see in your own industry. I found that hard. So
I'd agree with that.
yeah, but okay. Anything else you want to share with us? There's something we need to do. So if anyone's reading this or maybe listening to it, whatever that might be, how can they follow you? How can they find out more about you? Where's the best place to point them
So I'm pretty active on
learn
LinkedIn.
more?
So my LinkedIn, Adam Lawrence, and I try to respond to all the comments I get on my YouTube channel, which is called Proponomics with Adam Lawrence. So like property and economics matched together, but with an X on the end. And that's where I read all my content as well. Try to get the videos up weekly wherever possible. Sometimes I'm a bit constrained, but that's where I do a live version of my thoughts for the week, which will have various amounts of sort of real-time information. I'm quite keen on real-time information because I love reading reports sometimes when they talk about this new thing that they've discovered, and they're reporting up to March 2024 and it's September 2025. You think, I'm not sure that's too relevant today, folks, to be honest with you. So I try to sort of get into the real world side of it. I try and do all sorts of funky stuff, predict what inflation's going to do, predict what interest rates are going to do, all of that, mostly because I don't find much other prediction work out there that I find to be sufficient. So I do the work to try and get it right, and then I share it with everybody on the YouTube.
Okay, so that's Proponomics. That's where we're all heading now to find out exactly, well, I do mean exactly what's going to happen with interest rates. So it's got to get it right now. Yeah, brilliant. Look, Adam, thanks so much for jumping on this call today. It's really appreciated. We couldn't do what we do without people like yourself sharing real world experience. So it's a massive thanks from me and anybody reading this in the pages of YPN.
Thanks for having me.
Learn from people who've been there and done it. Real investors, real lessons. ypn.plus.